Good morning, everybody. The purpose of my presentation today is to give you a bit of an overview of the French market, but also to just highlight some of the risks that are inherent in the market at the moment, but also try and draw out where some of the potential opportunities may be for investors. Now, I can't really hide the fact that there are some challenges in the French market at the moment, so I shall start there. The impact of the euro crisis has had an effect on the whole Eurozone. It slowed growth across all of the economies, and obviously that's included the stronger and the larger economies such as France. France is currently in recession, has been for the last couple of quarters, has had negative GDP growth. We're currently running at about minus 0.2%. This is actually not that far behind Germany, which is at 0.1% GDP growth, and France is obviously performing better than countries like Spain, Italy, and so on. Looking at socialist policies now, there has been some blame on the socialist policies of the new government, François Hollande. There's the blame saying that they're damaging investment in the country and they're also undermining the confidence in the economy. Unemployment is currently very high. It's at the highest levels for quite a while, although this is still below the Eurozone average, but it is significantly higher than countries like Germany and the UK. At least Holland, you would say, maybe a little bit late, but he is actually starting now to try and incorporate some new measures to try and change labour laws, to try and make it a bit more flexible, to try and improve the system and try and rise employment. He's also reconsidering the retirement age, reconsidering dropping the retirement age, and he's also, at the moment, the 75% tax rule is actually currently blocked in a legal challenge, so we have to wait and see where that goes. The question is, will this stop the immigration of some of the wealthy, high-profile individuals and the students to locations like London, which is now considered the 6th largest French city ahead of Bordeaux, which is a bit crazy. But whatever the case, there is a projected return to GDP growth, like the rest of Europe, actually, in 2014. Now, I'm an investment agent, I'm not an economist, so it is my job also to remind you of some of the positives in the French market, or of France as a whole. It's the 5th largest economy worldwide, it's the 2nd largest economy in Europe. In terms of global Fortune 500, it's got a similar number of companies to Germany. It's got more than the UK, for example. It's got lower consumer debt than the UK and Germany. It's renowned for a superb infrastructure from an energy transport perspective. It's got a fantastic healthcare system, renowned worldwide for its expertise in high-end goods and services, whether it's fashion, luxury goods, foods, pharmaceuticals, and so on. And last but not least, it is the world's leading tourist destination. Probably part of the reason I've ended up being there for the last 6 years. I was attracted there in the first place. But on investment, so commercial property investment is one of the leading nations worldwide. In Europe, it's the 3rd largest after the UK and Germany. And more specifically on Paris, Paris is the 3rd or 4th city globally for commercial investment, behind London and New York. France has a very large, mature, transparent investment market. Investment volumes last year were 17 billion. This is running well above the average over the last 10 years, around 11.5 billion invested. The first quarter of this year had 3.6 billion invested. That's actually the most in the first quarter since 2008, and we're currently forecasting around 15 billion to be transacted this year. In terms of average size of investment volumes, generally it's around 20 million per investment transaction in France, but then that rises to around 35 million in the Paris region. In terms of buyers in the market is dominated by French investors, so generally they represent around 70 to 80% of the market. That's not to say, that's not to say though that it isn't interesting from an international perspective. So you've got it's an international entry point into Europe, similar to London. It's a prestige city, Paris, for high net worth individuals. So you've actually had quite a few trophy deals. You've had Primerica buying on the Champs-Élysées 130 million, sub 4%. And also last year, for example, sovereign wealth funds, you've had the Qataris who have been one of the major buyers in 2012. They bought a 500 million, the Virgin megastore on the Champs-Élysées. They've also bought two very big office buildings from Canam in the CBD of Paris. And that shows that German vendors are one of the biggest sellers in the market, clearly, at the moment, as they are elsewhere. But it's worked quite nicely for them that they've generally got quite high quality, good assets in the CBD, and actually with the high appetite for large investment volumes, this has actually been quite beneficial for the German funds. Degi also have recently just sold a 200 million tower, Tour Mirabeau, in the 15th arrondissement to Jacina. So you've also got French institutional money that is also picking up these large investment volumes. France is very centralized upon Paris from a political, economic, and an administrative perspective. This is no different for investment. You have 3/4 of all investment is actually in the Paris region. Likewise, you actually have 2/3 to 3/4 generally of all investment is actually in the office sector. You have retail generally runs at around 15%, industrial around 10%. Last year, we see that I've got other in black there. That actually refers to some portfolios of healthcare and hotel properties. For the rest of France, generally investors are focusing on regional offices, but mostly on Lyon offices. But for the purposes of this presentation, I'll be focusing a little bit more on Paris offices in the Paris region. Prime office yields are currently running at around 4.5%. This compares with London West End at 4%, Munich at 4.5%. Roughly we're around 50 basis points below the 10-year average of around 5% for the Paris CBD. Currently, 10-year bonds are running at historic lows of around 2%, so that means we've got a relatively attractive yield gap of 250 basis points. Just looking at key transactions, I think it's very similar, the market, to others across Europe and worldwide. There's a flight to safety. Investors want low-risk investments, so core investors are dominating. There's a scarcity of quality products. So there's a lot of competition on the best quality assets. This is driving price, and we're seeing yield compression at the moment. Looking at some of these transactions, the Vivendi headquarters on Avenue Friedland, French investor ACMV have just acquired that for 4.3%. So that's pushing the yield. It's going towards a bit of a trophy asset rather than just a prime offices here, but it's pushing the yields for assets. In Lyon, there's a lot of competition for this core CBD office building. I think there's around 15 investors that were bidding for that. This is because a lot of investors are very comfortable with the stability of the Lyon market. It's a very solid market, very low vacancy rates, and so on. Established yields in Lyon were generally around just below 6%. We're now seeing 5.75% for this asset. Again, that's a French investor that is buying that. Logistics prime yields are established around 7.25%. But if the right property comes along, we're expecting a little bit of yield compression there as well. This is a property where you've had offers just recently. It's Amazon. It's a new build, well located, long let asset to Amazon. And that explains, probably despite the large investment volume, why there's been quite a lot of competition. They're pushing the yield down between 7 and 7.25. Just on prime retail, Cordé Savills have recently bought the Tiffany's and Harry Winston in Paris on Rue de la Paix for 4.5%. That was the asset pricing, but actually it was a company transaction. And so the running yield from a company perspective that Cordé Savills would have been able to have shown would have been above 5%. And it's worth noting that the most aggressive French buyers in the market are targeting asset transactions. They have a clear preference to buy assets rather than buy companies holding assets. And generally the pricing, even for a good quality asset, is a little bit softer on company deals, we're finding. So this does mean there are opportunities for investors, maybe if they're willing to target company deals for a little bit less competition. Finally, I'll just say there's a big polarization between yields on core and secondary. With limited financing still in the market, there's also a little bit of a lack of forced deals, although this is changing with a few transactions recently. There's not that many opportunities for opportunistic investors at the moment, although that's increasing a little. Underpinning The strength of the investment market is actually a very solid, very stable occupational market in Paris. It's one of the largest markets worldwide, of about 55 million square meters of stock. It's got the best take-up consistently in Europe of all of the major cities. It's had a very robust last couple of years, and we've got a reasonably healthy forecast as well for 2013. Vacancy rates are also the lowest in Europe and historically have been so. They've been running at under 10% for the last 20 years, and they've only gone above 10% for twice in the last 40 years. So it's very positive aspects to the market from that point of view. Looking at the development pipeline, we've actually got a little bit of a shortage of Grade A supply, of good quality new build space. Grade A has represented around 1 million of take-up per annum over the last 5 years, and yet, as you can see, the last 3 years, this has been running well above actually what has been delivered. And also, if you look at the next 3 years, there's quite a high levels of pre-let space. You've got actually, on average, around 60% of pre-lets over the next 2 years, and that leaves only an extra 600,000 square meters on average over the next 3 years to be delivered. So again, this is implying there's a bit of a supply-demand imbalance. This supply-demand balance does help to maintain upward pressure on the prime rents, and currently the rents have been relatively stable for the last few years. They're running at the moment around 800 euros a square metre Zone A for prime Paris offices. We do forecast that the rents will soften a little bit. This is necessary to provide more attractive pricing to occupiers. Secondary rents are clearly under much greater pressure, so on secondary offices we'll see more of a softening in rents. And I think, but otherwise we do not forecast that there will be a stronger correction in the rents for the time being whilst there is this shortage of Grade A. So this leads us to try and see where we can try and draw out some of the potential opportunities in the market. We've been talking about Grade A and the slight shortage there. Well, in terms of available supply, 23% of the Paris region represents Grade A supply, and yet 70% of all transactions above 5,000 square meters over the last 5 years have been on Grade A space. So clearly this is going to imply that the already indicated shortage is actually going to become more pronounced. Also, looking at the age of the stock in Paris, you've got over 80% of the existing stock was delivered pre-2003. That's around 43 million square meters. That therefore means that you've actually got stock that is maybe already obsolete or could become obsolete over the coming years. And this therefore presents a bit of an opportunity to take stock maybe that's unsuited to demand, look to reposition it via maybe a change of use, or to refurb or rationalise the space in order to reduce costs and suit occupier needs in the current market. You may be aware of the Grand Paris Express project. It's very similar to London Crossrail. This has now been voted in, and it's going to be delivered over the next 15 years, well, 17 years up to 2030. This is a 30 billion project. It's a major transport infrastructure upgrade to the Paris region. We're going to have 175 kilometers of new metro lines and 57 new stations. And it's very, very positive. I'm going to show you some of the phasing of the works over the next 15 years. So, excuse the graphics, not the most pretty, but there's some extensions. This is the first part that's running up into the north of Paris, Clichy and Saint-Ouen on the left. But then over the next few years, we've then got extensions or new metro systems being put in place, linking Orly, Charles de Gaulle, north and south, and also improving the transport to be able to cut around Paris from east to west. Studies have forecasted a very strong positive impact on value, especially for clearly for the properties that are located near to these new stations, due to the greater accessibility, the greater development densities that are going to be in place, increased footfall from a retail perspective potentially, and therefore increased rents. Another recent study has also stated that public transport is the most important factor in tenant decisions on location. So clearly this means there's some very good opportunities that should be coming out of this moving forward. In particular, I want to draw your attention to 2 zones. which are going to particularly benefit from the transport links. This is going to be a bit of a new zone, really. This is Villejuif and Gentilly in the south of Paris. And then already an more established office zone, Clichy, Saint-Ouen and Saint-Denis. This is going to be one of the first branches to be delivered in 2017. We're seeing already yield compression on a couple of properties that we're selling in those locations in Clichy and in Saint-Ouen, where investors are buying into this new transport infrastructure, and therefore the pricing is actually improving in those locations. Before my closing remarks, I'd like to just draw your attention also to the total property returns, comparing the profiles of France, the UK, and Germany. Over the last 10 years, we're actually seeing that Germany appears to provide the most stable defensive return, whilst the UK provides the highest returns, but it's also the most volatile, whereas France appears to provide a happy medium between the two. It's also currently the best performing of the markets. So, in conclusion, yes, there are certain risks associated with the market. This relates mostly to economic and political situation at the moment. However, the historic and ongoing strength of the occupational market, combined with the large, mature investment market, does represent a solid market for core investors. Risk aversion will continue, probably with greater selectivity of assets and location due to the continued economic uncertainty. But there are opportunities out there, specifically as we've seen in the presentation, for well-located Grade A offices benefiting maybe from these future transport links, and that can be for core investors and more value-add opportunistic investors alike, depending on the age of stock or the refurbishment, repositionment opportunities that are out there.